Hello, this is our last video journal, and this week's title was Leadership Decisions for Accountants and Operational Budgets. So what is the cost of capital? According to our textbook, capital is a firm's sources of financing debt, equity, and other securities that is outstanding. A firm's sources of financing, which usually consist of debt and equity, represent its capital. The typical firm raises funds to invest by selling shares to stockholders, which represents the equity, and then borrowing from lenders, which represents the debt. Think of a basic balance sheet which lists the firm's assets, and the right side describes the firm's capital. So financial managers take into account each component of the firm's capital structure when determining the firm's overall cost of capital. So as we know, assets equals liabilities plus equity. So assets are your current assets as well as your long-term assets, and liabilities and equity would include your debt as well as the preferred stock equity. So the cost of capital also in this figure shows the capital structures of two real firms. So let's look at United Airlines, which is financed with about 76% of common equity and 24% in debt, while Frontier Airlines is actually financed with 84% common equity and about 16% in debt. I've used a pi ratio to give you an example of the debt versus equity ratio so that you could see the amount of equity versus the debt. So let's put this into action and suppose that TransCorp has a debt with a book face value of $10 million, trading at 95% of face value. It also has book equity of $10 million and 1 million shares of common stock trading at $30 per share. So if we looked back at this, we would compute that $10 million in debt trading at 95% of face value would actually be about $9.5 million in market value. 1 million shares of stock at $30 per share would equal $30 million in market value. So therefore, the total market value of the firm would be $39.5 million. So if we take that $9.5 million and we divide by the $39.5 million, this gives us a 24.1% for debt. And if we divide the $30 million by the $39.5 million, then we see the 75.9% of that is actually equity. So when looking at these, we get a much more visual representation of the equity versus debt ratio. As with anything, we always have ethical issues to discuss. So this week we learned about leadership decisions for accountants and operational budgets. We also learned about how companies can use capital to grow their businesses as well as help investors grow their money. Well, with doing all that, there has to be honesty and integrity, because if there's not, then the capital that's being borrowed is based on false pretense. People who invest in buying stock want to know that a company is making wise decisions for their return. So as with all business decisions, there has to be honesty and integrity. Many businesses in the past have taken stockholders' money and not made very wise decisions or investments or choices, which caused everybody to lose, not just the company themselves, but the stockholders as well. So as with anything, there is always a risk. However, if you do fail, at least with honesty and integrity, you can still sleep because you acted with honesty and integrity. The Bible tells us that unequal weights and unequal measures are both like an abomination to the Lord. And that was found in Proverbs 20:10 in the ESV. Again, my references were our online book, Horngren's Accounting.